Warren Buffett, often celebrated as one of the greatest investors ever, has achieved incredible success with investments in companies like Apple, Coca-Cola, and Bank of America. But even Buffett's made significant mistakes in his career. Have you ever wondered what went wrong with some of his most talked about investments? Curious about how these missteps happen and what they teach us about investing? Well, to know all about this, you have to stay tuned till the end. While it's good to learn from your mistakes, it's better to learn from other people's mistakes, says Buffett. Now it's a time for you to learn from his biggest mistakes and never repeat them again. In 1993, Warren Buffett's Berkshire Hathaway bought Dexter Shoe Company, and it quickly became one of Buffett's biggest regrets. Why? Well, there were several major errors in this investment. First, Buffett underestimated the challenges Dexter would face. At the time of the purchase, Dexter was doing well and had a strong return on capital. However, Buffett didn't fully consider the growing competition from cheaper foreign shoe manufacturers, especially from countries like China. By 1999, Buffett realized this mistake. He noted that domestic shoe producers were struggling because about 93% of the 1.3 billion pairs of shoes sold in the United States came from overseas. This meant that Dexter, despite its initial success, was up against formidable global competition that it couldn't match. The first key lesson from this mistake is the importance of understanding a company's competitive advantage. Before investing, it's crucial to evaluate whether the company can maintain its market position and fend off competition. Buffett's second mistake was about how he paid for Dexter. Instead of using cash, he used Berkshire Hathaway stock worth $433 million. Back in 1993, each Class A share of Berkshire Hathaway was valued at around $15,000. Fast forward to today, and that same share is worth about $517,000. This means that the investment didn't just cost Berkshire $433 million. It ended up costing them $15 billion in potential value. When Dexter's value plummeted, Berkshire Hathaway shareholders were left with a massive financial loss. This brings us to another important lesson. Avoid using valuable assets like your company's stock to make risky investments. It's better to use cash or other less valuable resources for such investments. Tesco, the popular grocery chain from the UK, was a significant investment for Warren Buffett's Berkshire Hathaway. By 2012, Berkshire owned over 5% of Tesco. However, things started to go wrong with this investment, and by 2013, it became clear that trouble was brewing. Buffett's team noticed problems at Tesco. The company's share price began to fall sharply, dropping nearly 50% within months, and this decline was due to weak sales and tough competition from discount stores. On top of this, Tesco was hit with an accounting scandal, and regulators in the UK started investigating the company. Despite these warning signs, Buffett hesitated to sell Berkshire shares in Tesco right away. Instead, Berkshire reduced its stake to 3.7%, representing $1.7 billion in investment. However, because Buffett waited too long to exit the investment, the share price continued to plummet. Ultimately, Berkshire Hathaway ended up losing about $444 million. From this experience, there's a valuable lesson to learn. Conviction matters, not just when you buy a stock, but also when you decide to sell. If you see signs that an investment is failing or if your confidence in it wanes, it's important to act promptly. Buffett, known for his careful investment choices, made a notable mistake with Energy Future Holdings Corporation. In 2007, Buffett invested $2.1 billion in bonds from this company, which relied on coal-fired power plants to produce electricity. He made this investment hoping that natural gas prices would rise, making coal-based energy more profitable. However, the plan backfired. Instead of rising, natural gas prices dropped significantly, and this drop led to huge financial losses for Energy Future Holdings. By 2014, the company went bankrupt. In response, Buffett and his team sold their bonds in 2013, but they faced a substantial loss of $873 million on their investment. Buffett later admitted that he had misjudged the risks and rewards of the investment. He acknowledged the value in getting a second opinion before making big financial decisions. Consulting with trusted advisors or partners can provide different perspectives and help avoid costly mistakes. This situation also highlights a couple of important lessons. First, predicting market trends like the future price of natural gas or other commodities can be very risky. Accurate predictions are hard to make and can lead to significant losses if things don't go as expected. Second, investing in high-yield bonds, often referred to as junk bonds, can be risky. While these bonds offer high returns, they also come with a higher chance of default. For large companies like Berkshire Hathaway, such losses might be manageable. But for individual investors, these kinds of investments can lead to serious financial trouble. It is crucial to be cautious with investments where the potential returns are questionable compared to the risks involved. In 2011, Buffett and his company faced a significant issue involving a deal with Lubrizol Corporation. David Sokol, who was the chairman of several Berkshire subsidiaries, recommended Lubrizol as a company to buy. However, Sokol had a personal stake in Lubrizol. He owned shares of the company, which he did not disclose to Buffett before making the recommendation. The lack of transparency raised serious concerns. Berkshire Hathaway ended up purchasing Lubrizol for about $9 billion. During this deal, David Sokol made around $3 million in profit from his shares in Lubrizol. This situation led to an internal investigation by Berkshire Hathaway, which uncovered that Sokol had been unclear about how he acquired his Lubrizol stock. It turned out that he had bought the shares only after being approached by bankers who suggested the acquisition. Initially, Buffett and Berkshire Hathaway did not hold anyone responsible. Buffett later described the situation as a matter of ethical concern, emphasizing the importance of following proper procedures. When making investment decisions, it is crucial to be thorough and ask the right questions. Don't rely solely on trust. Ensure that all relevant information is disclosed and verified. If your reputation or financial well-being is at stake, taking shortcuts or being lax in your checks can lead to serious consequences. Warren Buffett, known for his sharp investing insights, admitted in 2017 that he made a major oversight with Amazon.com. Despite keeping an eye on Amazon for years, Buffett never invested in it. Reflecting on his decision, he said, "I was too dumb to realize. I did not think Jeff Bezos could succeed on the scale he has." Buffett's mistake was underestimating Amazon's success. The company excelled in two key areas: dominating e-commerce and creating a powerhouse with Amazon Web Services. Buffett's traditional investment strategy, which often avoids high-priced stocks, didn't fit with Amazon's market value. By 2019, Amazon's price-to-earnings ratio was very high, and Buffett's approach generally shunned such expensive stocks, especially in technology sectors. Buffett's approach has always been to stick to industries and companies he knows well, his circle of competence. However, sticking too rigidly to this circle can mean missing out on opportunities in areas that evolve rapidly, like technology. As industries change and new leaders emerge, evolving your investment strategy can help avoid missing significant opportunities. Warren Buffett's openly admitted that missing out on Google was one of his big regrets. Despite Berkshire Hathaway's investment in Geico, an auto insurance company that heavily relies on Google's advertising to attract customers, Buffett never invested in Google or its parent company Alphabet. Buffett's oversight was partly due to his limited understanding of technology. While he recognized the importance of Google's role in Geico's marketing strategy, he didn't fully grasp the potential of Google's business and its long-term growth. Warren Buffett's most talked about investing mistake may surprise you. It was buying Berkshire Hathaway back in 1962. At the time, Berkshire was a struggling textile company, far from the powerful conglomerate it is today. Buffett's anger led him to invest in a business that continued to fail. Instead of being a brilliant move, the decision turned out to be a costly mistake. Buffett later admitted that he regretted this purchase deeply.